Okay, welcome back. So since the last video, all I did was I took all of our assets and I totaled them up and got a total of 464,000. And then I put a heading for liabilities, and then I included the first liability and the only liability that we got from the list up here. We saw all of them were assets as we went along, but we saw there was an electricity due, a bill that was due to be paid that hadn't been paid yet, money that you owed. So that was €400, and I put that in the liability section. Now, just again, I know I've said it already, but electricity due is a liability because it's money that you or the farm is due to pay. Okay, milk check due is an asset because that's money that's due to be paid to the farm. So that's money owed to the farm, that's money owed by the farm. Okay, even though they both say due, you have to take the context into account. Okay, so that was the only liability up here, but there are usually in this question two other liabilities that aren't listed above that you have to work out from the lodgements and payments section. So, and what they are is a bank loan and bank interest. Now, what we notice is in the check payment side of the money that you paid out during the year, it says that on the 30th of the 4th, 2005, so during the year, during April, we'll say, or the end of April 2005, you paid off a bank loan that you owed, plus you paid 18 months interest at 6% per annum that you owed. And altogether you paid 16,350. So that figure is made up of the loan that you paid back and interest that you owed that you also paid back. Now, so what we suggest then is that, well, if you paid back a long-term bank loan during April of that year, then at the start of the year, during January, the 4 months before that, you obviously had this loan that you owed. And so if there was money that you owed as a loan at the start of the year, that is a liability on the 1st of the 1st, 05. So it must also be included here. Also, if you owe 18 months of interest on the 30th of April, the 30th of the 4th, then you didn't, all that interest couldn't have accrued between January and April. You must have owed interest prior to the 1st of January as well. So that's more money that you owed on the 1st of January. So there should be over here the bank loan that you owed at the start of the year and the interest that you owed at the start of the year. So I'm just going to put bank loan and interest. Okay, and that's going to be all there is. Okay, so here's where it's tricky enough, I suppose. In this question, you see, they don't make it easy for you. They don't tell you, well, here's the amount for the loan and here's the amount for the interest. They bundle it together into one figure. So you've got to untangle this figure and figure out which one is loan and which is interest. So what we'll do is, first of all, we'll maybe go over to this page here and do our workings. So loan plus 18 months interest is equal to, it said it was 16,350. Okay, so what do we know about the interest for a start? The interest is 6% per year, and there's 18 months of it included in here. So if it's 6% per year, and then what would 18 months be? 18 months is a year and a half, isn't it? So if it's 6% for 1 year, for a year and a half, it would be 6% plus 3%, wouldn't it? So if we'll say, let's do it this way, it might be easier for in the future, you might need to do it this way as well. If 12 months interest is 6%, if you want to know what 18 months interest would be, well, then you'd need to maybe divide this side by 12 and multiply it by 18. Would that be worth it? So 1 month would be divided by 12 and then multiply 18 times 1 is 18, 18 times 0.5 is 9%. Now, obviously it's easier to maybe say that if 6% is 12 months, then that's a year. Half a year is 3%. So this 1 year and a half year or 1.5 years is 6% and 3%, which is 9%. However you like to figure it out yourself is fine. Okay, so if 18 months is 9%, if we take the loan as being 100%, plus we say there's 18 months interest, which is 9% of the loan, and we say altogether that comes to 16,350 euros, well then if we add this together, we're saying that 109% of the loan is 16,350. From that then we can work out what 100% would be, and indeed what 9% would be. So what we do is we divide. I'll have to get a calculator for this. If we want to divide by 109, we'll get 1%, and then multiply by 100, we'll get 100%, which we said is the value of the loan. Okay, I will need a calculator for this though. Or maybe not. And so it's going to be 150, I believe. If I divide this figure by 109 to get 1%, and then multiply by 100 is 15,000. So the loan part is 15,000. So if the loan is equal to 15,000 and you repaid 16,350, well, if I subtract 15,000 from 16,350, I get 1,350. That must be the 18 months interest. Does that make sense? The loan and the interest comes to 16,350. We worked out the loan was 15,000. So if I subtract the 15,000 from the 16,350, I get this 1,350 of interest. Okay, so here's where there's another twist. That's fine. Over here, we know the loan is 15,000. And we must put in a figure for interest. But this is just the liabilities or the money you owed on the 1st of January 05. It says over here that you paid back 18 months interest, 1,350 on the 30th, wasn't it, of the 4th 05. Okay, so let's just double check that, the 30th of the 4th 05. So you paid back 18 months interest on that date. That means on that date you owed 18 months interest. But that doesn't mean that you owed 18 months interest on this date. So we should not be putting in the full 18 months interest down here. Well, as we know with interest, the longer time goes by, the more interest you owe. Isn't that right? When you borrow money, the longer you hold on to it, the more interest you have to pay, because you only pay the interest while you have the money that the bank has given you. Every year you pay more interest. Every month you pay more interest. Okay? So if by the 30th of the 4th, the end of the 4th month, you owed 18 months interest, well, if we go back in time 4 months before that to the 1st of January, well, then you only owed 14 months interest. Isn't that right? And then as time went by, 1st of February, you owed 15 months interest because you hadn't been paying your interest. 1st of March, you owed 16 months interest. 1st of April, you owed 17 months interest. 30th of April, you owed 18 months interest. So if we go back 4 months to the start of the year, you owed 14 months interest. So we want to find out what's 14 months worth of interest, and we want to put that figure in here because this statement of capital is for the 1st of the 1st of January, the start of the year. Okay, so straightforward, same kind of calculations we've been doing all the time. We say 1350 is equal to 18 months of interest. So we can divide by 18 to get 1 month, and then we can multiply by 14 to get 14 months. Okay, I would definitely need a calculator for this. I'm just going to pause and do the calculations. Okay, so dividing this by 18 gives me 75 euros. Okay, multiplying 75 by 14 gives me 1,050. So 1,050 is the amount of interest you owed at the start of January, and of course because you didn't pay back the loan until April, the interest just kept going up and up and up, and by 4 months later you owed another 4 months interest, and this 1050 went up to 1350. But the 1050 that you owed at the start of the year is what we want to put in here. Okay, so totaling those three, that gives me 16,450. So adding this, this, and this gives me 16,450. Now what we're going to do is subtract the liabilities from the assets. So we put brackets around that, and the difference that we get is going to be our capital. Okay, and in this case it's 447,550. Okay, and we're done. Okay, so some difficult things here, I suppose. Most of the assets and liabilities we just take from the top of the question here, but there are, I would say, 4 things that you always need to look out for. The bank figure always comes from either top of here or the top of there. If it's on the left hand side, it goes in the assets. If it's on the right hand side, it goes in the liabilities. The investments figure, well, there's a little trick to that. I suppose we need to be looking for investment information here, here, and down below, and we'll look at another example of that in a moment. And then the loan and interest figure, they're the tricky ones. Generally speaking, in this question, they are bundled into one figure down here, and you need to unbundle it. You need to figure out how much is interest, how much is loan, and then after that you need to figure out how much of the interest that you got from here should I actually be putting into this account.